A red-hot US inflation reading sent a shiver through markets. Consumer prices saw their biggest jump in 40 years, with inflation hitting a higher than expected 7.5% in January. And it was largely driven by the essentials of food, power and housing. The inflation chart by itself is somewhat extraordinary. It's even more extraordinary when you compare the overall inflation rate against just the energy price component, which is up an astonishing 27%. Over the same period, wages fell by 1.7%, so households aren't going to be happy. It prompted a US Fed Reserve member to call for a full 1% rate hike by July 1. Now, notwithstanding that, markets are now pricing in 6 rate hikes this year instead of the 3 that were forecast in December. The comments from James Bullard saw Wall Street hit the skids in late trade. Inflation was the flavour of the day in Canberra too, where the RBA boss reiterated his reticence to raise rates. Dr Lowe told the Economic Committee inflation is much tamer in Australia and hiking rates too early could put full employment and higher wages at risk. But he conceded that could all be out the window if inflation does get away. The local market declined throughout trade and it closed down 1%. In company news, Wesfarmers' purchase of API, the owner of Priceline Chemists, was cleared, while iron ore stocks were the bright spots thanks to a lift in commodity prices. Now, with all this talk of rate increases, here's a chart on how much 3-year savings rates have been cut over the past 2 years compared to how much 3-year mortgage rates have lifted. The halcyon days of saving may return one day. That's finance.